Welcome back, everyone. We hope that you had a great lunch. We will now commence with our next panel discussion on risk management in the long term. The session chair, Mr. Lutfi Siddiqui, adjunct professor at RMI, will be introducing the panelists and commencing the panel discussion. So, without further ado, Mr. Siddiqui, please.
Thank you, and good afternoon to those in Asia and good morning to those joining us from Europe. Welcome to this panel on risk management in the long term at this 14th Annual Risk Management Conference in Singapore. My name is Lutfi Siddiqui. I will be your moderator for this session. Amongst other roles, I am an adjunct professor at NUS Risk Management Institute, having had the distinct honor of being part of this journey since the beginning of RMI and the very first of this series of annual risk management conferences. Now, we all have biases and hypotheses that we bring to any debate. And before we dive into the panel, I thought I would just put forward two provocations. First, I'm beginning to believe that today's risk management challenges or today's risk management actions are the main cause of tomorrow's risk management challenges. So today's risk management is the main cause of tomorrow's risk amplification. Listening to this amazing keynote earlier today by Professor Darrell Duffy, where he spoke about liquidity air pockets in the market for US Treasuries last year in March, I couldn't help but think that the market structure that caused that event is a direct consequence of some of the measures, the regulatory measures and other risk management measures taken in response to the last financial crisis. So short-term fixes can store up long-term problems. Painkillers can give immediate relief, but might breed dependence on more painkillers going forward. So for this panel on long-term risk, I thought I would put that out there as my bias. The second provocation is that today's siloed approach to risk management, whether it's siloed at the level of risk factors or even at the level of entities, ignores important things at a systemic level, the interaction and feedback loop between players in the system, who is included and who is not included in the definition of the financial system. Is the financial system a mechanical, hierarchical system in the engineering sense, or is it more of an ecological, emergent system, even a chaotic system at times? And if we fail to appreciate the systemic interconnected nature of risk, then maybe we're missing something. And maybe these risks materialize, or because they materialize infrequently and only in the long run, maybe we don't give them as much focus as required. So in this panel, we will explore long-term risks. What are they? How should we think about them? How can we practically deal with them? And we have a distinguished and diverse panel here with us today. Diverse in terms of vocation and location. And I will introduce them just before I invite them to speak one at a time. And I'd like to start with Dr. Christine Chow, and then move to Peter Giger, Ron Anderson, and then Bob Price. So I'd like to start with Christine, but by the way, a reminder to the audience, this is meant to be an interactive session. So please keep your questions coming as they occur to you. You don't have to wait until the very end. So joining us from England, somewhere outside of London, Christine Chow, PhD, is Executive Director and Global Head of Strategic Governance and ESG Integration at IHS Markit. Prior to that, she was Head of Stewardship, and she was the Technology Lead at Federated Hermes in Asia and Global Emerging Markets. She is a board member of the International Corporate Governance Network, ICGN, and an honorary advisor to the Financial Reporting Council in Hong Kong. Christine and I have served on a University Endowment Investment Committee together, and at a time when they became signatories to PRI, and so we had governance responsibility to demonstrate that ESG factors were given adequate attention. Christine was pretty much the architect of that accountability framework. So Christine, welcome. Thank you for joining us early in the morning. Over to you for your opening comments, please.
Thank you very much, Lutfi, and RMI for the very kind introduction. I'm afraid that the UK internet, especially I live in the countryside, is not as good as what we have in Asia. So if there's a bit of a lag, do excuse me. And I'm very honored to be on a distinguished panels with the rest of the an amazing lineup of speakers, and thank you for that. So maybe we can start off with some slides. If you are able to see them. I want to keep them very short because it's supposed to be an interactive session. I want to start off with what is risk management in the long term in the next slide. When I joined the investment management industry, that was back in 1997, a long time ago, and I got very interested in what used to be called ethical investment. And it was deemed very niche. And we already were talking about climate change. However, the general sentiment at the time was that it is very long term. It's not going to impact investment. And I think now we still see climate change as a very long-term risk. But because of a range of different factors that Lutfi has just mentioned, looking at investment as an ecosystem, there are changes in the ecosystem that make it long-term issue a lot more short-term. So we're going to go through a little bit of some of those factors. And the first one here, you can see CalPERS is one of the key US-based pension fund here. And the change in investor attitude towards these very long-term issues and how active they have become has certainly made a difference. So next slide, please. I remember back in, I think it was 2017, when one institutional investors participated in a shareholder proposal at Shell that urged the oil and gas company, the Anglo-Dutch company, to disclose Scope 3 emissions. It was an absolute no-no. There was very, very little support among shareholders. Fast forward to 2021 this year. Not only, you might remember this year on one particular day, I think it was in May, I forgot the exact date. That was the day the world changed. That was the day when ExxonMobil, engine number one as a hedge fund, actually managed to harness the votes and support of many institutional investors around the world and put ultimately 3 board members on Exxon, a long-established oil and gas company. And pretty much along the way throughout the campaign, asking for a change in direction to embrace low carbon transition, address climate change issues, very long term. And on the same day, the Dutch court actually ruled that because of under the framework of the UN guiding principles for business and human rights, it's a human impact angle that Shell actually needs to be better at addressing climate change issues that cover Scope 3 emissions. And why am I talking about Scope 3 here as a long term? It's because it exactly reflects what Lutfi was saying about the importance of an ecosystem. Sometimes we see companies as being in an industry, I'm an investor, this is my hat, or I'm not representing an investor, now I work for a data firm. And you see that actually everything is interconnected. If you look at the industries here, say if I were running a e-commerce industry based in the US, right? And what if I need to report to TCFD and really think about my ESG reporting, what do I need to know, right? I have an e-commerce business, consumer retail, mainly facing US customers, but my supply chain actually comes from Southeast Asia, from China. What do I need to know? Well, first of all, I need to know that my Scope 1, Scope 2 operations emissions. What are my energy procurement options in the areas that I operate, in the different locations? Secondly, I need to understand my logistics framework. What kind of cars, well, am I still using diesel cars? Well, that's probably not a very good idea. I should at least look into hybrid options, but then electric vehicles, but then it runs into issue of what are my options if they have to travel very long? Do they have the local infrastructure? So then I need to talk to the government about what might be the support that I need to enable me to transition to a complete 100% EV fleet. And then they need to think about, okay, in my products, what am I selling on my e-commerce platform? Am I providing the right kind of products that supports my customer base that are looking for low carbon emissions product that have a lower environmental impact, but potentially even a positive social impact? So I might be selling shampoo, or I might be selling food products. And all these things actually bring together every single sector. Nothing exists in isolation. And you can see here, it's a chart provided by created by my colleagues. At IHS Markit, we have different industry verticals and also industry groups, experts. We have colleagues with 30 years of experience working on emissions regulation, and they put together this chart that kind of tells me, how am I going to help manage scope 1, scope 2, and scope 3 if I were running a particular business? So next slide, please. We also provide different options in looking at scenario analysis and climate scenario. Of course, there is the IEA scenario, but that's not the only one. And we work with our clients on providing various scenario analysis that can sort of benchmark with IEA, but looking at different options that they have. Next slide, please. So earlier I talked about the evolving landscape of risk, but also opportunities. Risk does not exist in isolation, because when there's risk, that means that there is imperfect information, and those who are good at making decisions based on imperfect information, who can capture imperfect information in a material way, will find the opportunities. Some of you might have heard of the book by Principles View by Ray Dalio. He talks about the importance of the 20% information, that you have to have the right access to 20% information. And that doesn't come along for free. It comes from synthesis, it comes from judgment, it comes from experience and the ability to draw together the different information that you have. So here I give you 4 trends to think about. First of all is in the evolving investment landscape of sustainable investment in ESG. On the top left, we're looking at the inflows to ESG. Yes, we already know that it's been massive, but where does it go to? Right, it goes mainly to passive. Actually, over the last 5 years, the compound annual growth rate of passive funds is based on our internal information. It was growing at about 40%, over 40% per annum, whereas compared to the active funds that is deemed ESG fund has been growing in this comparable period over the last 5 years, compound annual growth rate of 27%. So definitely the passive growth is there, but how and where? And there's also the exchange traded funds. So we're seeing even active managers are launching ETF exchange traded funds that are more liquid into this space. So I think that this is definitely one trend to note, and also it reflects that active managers are also looking at ways to scale up the ESG operations, because it could be very research intensive, and how can you scale up and improve the margins of these products is a key area. And bottom left is the maturing approach of ESG integration. They used to have like the voting team, they work alone, and then you have investment team that work alone. Increasingly, we've seen cross-fertilization, and companies that are really good at really integrating ESG issues are the ones that work very closely together as a team, as an ecosystem, as Lutfi was referring to, a mini ecosystem within the firm, but also with a sector and market specialists. And some examples here is also investors working together, such as Climate Action 100+, and I'm definitely going to see more of those coming. Top right, and a focus on climate transition and nature-based solutions. Yes, we already know climate is firmly in place, but being based in Singapore and being exposed to Southeast Asia, you probably know that there's long been a lot of discussion around palm oil, land issue, water stress issue, flooding issues. So a nature-based solution is definitely coming our way. Nature Action 100 was formally sort of formed with investor support earlier this year, so watch this space. And lastly, active ownership. I have already mentioned that as a way of engine number one is one example, and they leverage on that opportunity, having a success at Exxon, and launch the ETF called, actually, a very good name, Vote. Getting a very good name is actually a first step towards success in a way, because people will remember your strategy. So I'm going to go through the next few slides very quickly. This is a panel discussion. I think that next slide, it's just a way of demonstrating the importance of stewardship in Paris. When the Paris Agreement was coined in 2015, when we talk about when we talk about Paris, we just thought of Eiffel Tower, we think of a very romantic city, but now when we talk about, are you Paris aligned, is a completely different conversation. And then 2019, Net Asset Owner Alliance was formed in September. And then what happens? The investment chain, the power of stewardship, the power comes from the asset owner, the pension funds, the savers, the pensioners, which impacted the asset manager, because ultimately asset manager is an investment agent, and the race to zero began. And the next slide is just a brief record internally what we have, looking at the voting behavior and the say on climate. I personally think that we're going to see more regulation around probably advisory vote or regulators expecting more disclosure on how companies on all sectors, not just oil and gas or utilities and mining, manage their low carbon transition, and ask shareholders to have a bigger say on climate. Next slide, please. Next slide is just a very high-level summary of a very important regulation in the EU. This is the Sustainable Finance Disclosure Regulation, which focuses on categorizing different funds and trying to address the allegation of greenwashing or SDG washing of investment funds, which actually puts manager in a position we really have to demonstrate their ability to address controversies, ESG risk issues. And it's just a high-level example. So my last slide is just a pretty picture from our transportation team. Well, what is risk? Risk is when we're exposed to the unknown, when you're not prepared. But when you are prepared, then it's an opportunity. So thank you very much for the opportunity for me to share with you this slide. Thank you.
Christine, thank you very much. And I'd like to come back to you with a question. Let me give you the question now, but I'll come back to you with that, which is, if I understood you correctly, what used to be seen as very long range risk has really come forward, partly because in the form of event risk, change in regulations, shareholder action, you mentioned ExxonMobil, or customer action, consumer actions, or the courts, or changes in laws, and so on. My question to you is, do you think there are more stranded assets, more financial assets that are stranded that we may be aware of, in which case is that a material risk for the investment community to keep in mind? So I'll leave it with you, not to answer straight away. Now, allow me to bring in my next guest, Peter Giger, DBA, joining us from Switzerland. Peter is Group Chief Risk Officer at Zurich Insurance Group and a member of the firm's executive committee. Previously, Peter served as head of the Swiss FINMA's insurance division, FINMA being the supervisory authority, financial market supervisory authority. I've had the good fortune of listening to Peter on a couple of occasions. He brings a truly unique perspective from both the business and the regulatory side of the table, both from a practical and conceptual view on risk. So Peter, welcome, and over to you for your opening remarks, please.
Lutfi, now you just made me a little bit nervous by setting the expectations so high. Good morning, everyone, and a very interesting topic indeed, the long-term perspective. And my first question would be, well, define long. And in a way, the climate discussion gives us a good benchmark. I mean, 2050, I take that as long-term. Some people would take much shorter perspectives. But one of the big issues, I think, is deep in human nature. Humans would love to know about their future. I mean, they started consulting the stars ages ago. And I think we're still in that same mode often. And we think that by just kind of gathering enough data, we can know the future. And we've actually made that mistake time and time again. And, you know, especially, I mean, the insurance industry dealing with uncertainty in its daily business should know better, but is prone to making the mistake as well. And kind of the reason why I think we're failing here is that humans live in an illusion of stability. And we do not recognize that every action creates a reaction, although I think we all learned in school, it's basic physics. And so the future becomes very chaotic very quickly, because there is an infinite amount of players making decisions. And how could you model all of them? Though people still try to. I find that fascinating. And again, taking the climate discussion, I think, is a perfect example where, based on today's technology, we try to decide the world of 2050. Now, think about that for a moment. Had you decided in 1990 how the world in 2020 should look like, and then subsidize the technology and actually pretty much force the technology through the system, we would live in a different world, because so much happens within that time horizon. And so my first plea is one for humbleness. I mean, let's be clear that we cannot know what we cannot know, however much data we throw into. And let's be open-minded to what the future brings. Because at the end of the day, I think, again, society proved in the COVID kind of how you can manage an uncertain future successfully by stimulating the human minds. And we came to vaccinations, and I'm using the kind of the multiple because it's a number of vaccinations within an incredibly short period, because we didn't decide what technology would use on day one. And I think that's what bothers me in much of this long-term discussion, that we don't allow for the change that will occur, that must occur. And Lutfi, you actually mentioned the systemic risk component. That's one I, as a kind of member of the financial services industry, find quite concerning. Because whenever I hear systemic risk these days, for me, it sounds more like a synonym to protect the current world as we know it. It's a defensive, structural kind of move. When we all know that our economies work through trial and error. And if we start to protect certain structures by calling them systemic, well, we'll hold up innovation, we will hold up development. And in many areas, I think that we can already observe how the development is slowed down by not letting fail companies. And I think that's, for me, when we talk about designing the process for long-term risk management from a company perspective, that's a key aspect. Because as a company, Zurich is around 150 years old. So kind of, we certainly have the ambition to be around in 2050. So how do we shape our enterprise risk management? Well, first and foremost, we have the strategic challenge to stay relevant for our clients. Hopefully, we don't stay around because we're called systemic and protected by some regulation. Hopefully, we stay around because we stay relevant for our customers. And I think that's the biggest long-term challenge for any companies. And that's why companies come and go, because they don't manage to stay relevant for their customers. They don't manage to adapt to a changing environment, to changing technology, and I think the key here is that the longer out you go, the more you have to build in the inherent uncertainty. Nobody decides whether to take an umbrella next year, because we all would call that foolish, but we show similar behaviors in our corporate world, that we try to make decisions prematurely, and we all have to act under uncertainty. But I think the key is to make the decision at the right point in time, not under perfect information, because again, the future is unknown, as a famous author once said, and it will always be. If I reference a book in that respect, it's The Hitchhiker's Guide to the Galaxy. Actually, I think it's still the best reference on the failure in this area. And my colleagues know that if I mention the number 42, they know exactly where I'm coming from, because that will be the answer ultimately. And that's, for me, the key aspect here is basically to accept kind of what we know and what we cannot know. But that's not an excuse for not using all possible sources of information. If you talk about emerging risks, for example, I would reference the CRO forum, which brings together the various insurance companies, and it's an incredibly powerful intellectual group. And listening to them will give you an idea about the things you should think about. But then, notoriously, the biggest risk comes from the things we don't have on our radar. I mean, again, that's you can go back time and time, and it's what we don't think about that surprises us and finds us unprepared. Usually, as soon as the risk is on the radar, we naturally take mitigation measure to at least remove the catastrophic downside, so to speak, if we can. And I think that's, again, another important aspect. And then the last element in that process is really that you need to apply judgment, and you need to make decisions under uncertainty. Don't rush to them. I think in the climate debate, I'm very concerned that we're trying to make decisions prematurely. I mean, everybody jumps on subsidizing electric vehicles. I go like, really? I mean, not that I'm an expert in it, but I'm just surprised. Why are we banking on a specific technology? Again, we have 30 years in front of us. I mean, terrific technology will be introduced if we let it happen. And by the way, why are we conserving a mobility behavior that has developed? Our company has been around before cars were even introduced. I have every confidence that we will be able to adapt to a post-car world. And anyone thinking about the post-car world? Because the solution, again, it's not instability. The solution is in development. And when you think about your risk management, I think that's, for me, the key aspect, is that the future is uncertain. Let's accept that. Let's be open to change. Let's propagate change, by the way. And then I think the future is actually bright, because I'm a risk manager, but I'm an eternal optimist. But you need that optimism. And one of my concerns today is that companies and societies at large start to act very, very defensively. And we try to protect. And by protecting, basically, we create a whole host of new risks. As you rightly mentioned, everything we do creates the next problem. And I use an example out of the insurance industry where regulation forces companies to go into government bonds, because that's considered the risk-free kind of asset that covers your liability. That's the holy grail of asset liability management. Now, that whole concept was developed in a world where markets basically gave a price. Now, some of us may remember when markets gave a price, but today central banks give you the price. And so we're trapped in a situation where we're pushed by regulation into a behavior that is no longer based on markets. You know, in my mind, there is no more market consistency out there, because markets are heavily manipulated by central banks. Nobody talks about that even on the regulatory end, whether the regulation still makes sense, because it was meant to be market-based. And I think, for me, I fully agree with you. We need to be very careful not to forget the implications of what we do today on the world tomorrow, because, again, there is no stability and there is a reaction to every action.
Thank you, Peter. And if I understood you correctly, you are proposing some caution in trying to overmanage risk that is long range, and to allow, whether it's technology or other business processes, to play out without a lot of intervention at this time. But I assume you're not saying that we shouldn't be building resilience. There must be some action that we will need to take. So my question that I'll come back to you on is, what's the right balance between keeping an eye on the long range, the long-term risks, without trying to be too deterministic from a pessimistic baseline. So I'll come back to you with that question. I'd like to now invite Professor Ron Anderson. Dr. Ron Anderson is a professor of finance at the London School of Economics. He's a member of the Financial Markets Group and a principal investigator in the Systemic Risk Center at LSE. For about a decade, he was responsible for LSE's Masters in Risk and Finance program. And in recent years, he has worked on the Chinese debt market with a particular focus on the relationship between credit risk to enterprise reform and public finance at the local level. Ron, welcome. Thank you for joining us, and over to you.
Well, thanks very much for the opportunity to participate in this very interesting panel. I have some slides that I'd like to refer to, and if I'm going to actually have some comments that are similar to what Peter has just mentioned early on. Notice that he said that at Zurich we're concerned about, and in insurance in general, we're concerned about uncertainty. He didn't say risk, okay? And that's a distinction that I think is a useful one, okay? So in particular, to look ahead in the future, we have to realize that the long term is qualitatively different than the short term, in the sense that short term we maybe have some tools available to us that are informed by data that's available to us. But when you go further out, that's no longer the case, okay? When you go out further, you have to recognize that the relevant kinds of events are only dimly visible to us. Sometimes they're completely invisible to us. And you need not to look back at the recent past things that happened, but you have to look back to the distant past when you realize that people were caught unawares often by what has occurred. So there's no choice that in trying to look ahead, we have to look back, okay? But the longer you look back, the more it is not analysis of data that has been available to us, and we can use statistical tools to estimate probabilities. It's more really thinking about the big picture events that could occur. And only later can we start to assign probabilities to things. And that's very difficult. The other thing that I'm going to catch up on, or emphasize, is governance, the importance of governance in thinking about the way the future may unfold. And I'm going to start off by talking about this in the context of finance. And I want to draw on the example of the financial crisis, because I think we go back to the financial crisis starting in the North America and in the US in 2007, 2008. We can see some of the elements that I just mentioned. So while the subprime mortgage market difficulties were coming on the radar screen throughout 2006, I fix the beginning of the financial crisis as the summer of 2007, when suddenly we began to think that this is bigger maybe than just the subprime crisis. It's when, for example, losses were occurring on the books of the Stadtbank in Germany that had bought into a variety of products. We became aware that they were exposed to the subprime crisis and so forth. It was also in August of 2007 when quant hedge funds started to behave in very strange ways that for reasons that were difficult to perceive, relative values started changing quite rapidly. And only a couple of months later, we began to see that actually a lot of the hedge funds, the quant hedge funds, started to have problems with liquidity. Okay, so in retrospect, after several years of experience in looking into this, we have learned that a relatively small segment of the financial market had difficulties that were transmitted through funding characteristics, okay? And those transmission mechanisms had been building up slowly over a matter of a couple of decades. It's essentially the securitization process that we came to now know about as it grew up in the United States. Now, for a long time, securitization only seemed to be a good thing. It improved efficiency, it facilitated capital flows and supported growth. Right? But in retrospect, we learned that it depended upon the continuation of an important linkage that was interrupted starting in 2007. It depended on the continuing liquidity of funding markets. Okay, at the onset of the financial crisis, we learned that that assumption was no longer holding. Okay, and once that happened, that shocked relative valuations in the markets. Peter mentioned the fact that a lot of people assume that we have market valuations, but in fact, at times, market valuations totally break down. It was very difficult to determine which assets are over or undervalued, okay? And the correlations between quoted prices and traded prices started to break down, and the hedges no longer worked. People fell back on their own and hoarded liquidity. And so that's how it unfolded. Now, we spent a lot of time over the next few years trying to learn the lessons of the market and what were the deep, really causes of the financial crisis as it unfolded. And I think a lot of people felt that they had learned, but had we learned? So let's take that question and look at it in the context of the growth of Chinese debt. That has been a major source of interest throughout the world, and particularly in Asia. Following 2009, and following the decision by the Chinese authorities to stimulate the economy to counteract the effects of the global financial crisis, or I should say the North Atlantic financial crisis, there was a very large fiscal stimulus. And analysts began to document the enormous growth of this enterprise debt outstanding, and also of shadow banking. I should say, incidentally, this got attention largely because the Chinese government began to publish monthly aggregate social financing in various categories. And everybody was treated to see monthly this explosive growth of this mountain of debt that was coming out of China. So by 2013, the risk assessment of many, and perhaps led largely by the IMF and the OECD, was that China urgently needed to get control and impose financial discipline, improve bankruptcy proceedings, and rely on the market and the courts to and the sovereignty of the contracts to deal with the problem. They needed to burst the bubble, okay, before it got too large. Now, in fact, the Chinese authorities didn't do that, okay? They allowed debt to grow. Instead, however, they took a variety of actions that were not so widely recognized at the time to transform the structure of the debt markets themselves. They realized that a lot of the problems had to do with the finance of infrastructure projects by local governments through their local government funding vehicles, private enterprises or other platforms that were allowed to raise funds. Okay, what they did was essentially shut that down. And they authorized the issuance of genuine muni bonds at the provincial level and other large local government levels, and prohibited or restrained the local governments from using their funding vehicles to raise money. And they started to make clear that some issuers did have legitimate government backing, while the other issuers really had none. So that people, the market began to realize that they had to maybe potentially bear the risk. That was followed up by allowing for more defaults, by some improvement and use of bankruptcy, but more importantly, for the bigger problems, coming down hard on the provinces to deal with their debts that were becoming difficult and restructure the things. And that's been basically how it's unfolded since then. Over time, the credit spreads have increased enormously for certain categories of debt. And effectively, a lot of people recognize that the private sector has got to bear quite a bit of that risk, and investors could have to bear quite a bit of that risk. So now, what was there about this that was not totally understood at the time? No. So how could analysts, vintage 2013, have done a better job to see what was going on? In my view, I think it's the absence of thinking about market governance and how it differs across different systems that led people to really not quite understand how things would unfold in China. So as we know, in 2007, we recognized that segmentation of regulation played an important role. Some institutions were regulated by the SEC, some were regulated by the Fed, and et cetera. And it was difficult, the mandates were such that it was difficult for anyone to particularly connect the dots between them. Things unfolded very differently in China, largely because they operate differently. And I want to refer to what is sometimes called in China the regionally decentralized authoritarian system. So while ultimate authority resides in the public sphere, is held centrally, in practice, things are delegated down to local areas, provinces, and counties, and so on. And so that has allowed a lot of experimentation and different solutions in different parts of China. However, the center retains the authority to step in and fairly quickly change the structure as required. And that's what I think led to this deleveraging strategy that was taken forward. Now, how can we build governance and other long-term considerations and social into the analysis of looking at the long term? Okay. Doing simulations based on heavily relying on data and so forth, and the routine sort of stress testing that we have become useful is of extremely limited use in this area. Really, what is more important is to think about what are the future events. And for this, there can be scenario analysis that can be done collectively. I mean, you can also read the books about the future, popular books that are easy to read that talk about the sort of the unthinkable and so forth. But trying to bring that into focus among a group of institutions, businesses, and government regulations and so forth, there should be a more slightly structured way of dealing with these scenarios. And we know some of the techniques that have been developed along the way: scenario analysis, experimental games. I think war games are great, and I've participated in some what you could call financial war games, where diverse people with a lot of experiences within the sector get together in an organized way, hopefully for a day or more, not for half an hour, and are locked somewhere to go through try to define the scenarios, and then have teams that reflect different players in the setup, and then see the kinds of solutions that they would put on the table and so forth. I think that can be extremely stimulating. I think that some of this has been taken on board in stress testing. So I think that we are running a little late, so I'm going to try to stop there. All I would do is point out the bullet points on the next slide. One thing I think you should start thinking about is, what are the long-term consequences of cryptocurrency? Okay, and I won't add too many words to go with this picture. I'll just ask you to try to identify this picture. This is saying Bitcoin is accepted here in Spanish. And this is in El Salvador, which in early June adopted Bitcoin as a legal tender along with the US dollar. As a result, this is the future that anybody trading with El Salvador or in El Salvador has to deal with. Here's the price of coffee. This is the price of coffee in dollars in blue, and in Bitcoin in orange or whatever that is. And they've had the Bitcoin price of coffee has gone from 2 to 1 in about 6 months, and now it's gone down to 0 effectively on this graphic. Okay, so but you've got to be able to pay with Bitcoin or dollars. And so if you were a businessman in El Salvador now, you're suddenly learning about arbitrage, okay, and how to deal with that. And we can hope that the El Salvadorians all get fantastically important liquid futures markets that will deal with all these problems for the farmers in the fields on their smartphones. But I have my doubts. And I think that we're looking at the kind of volatility that the El Salvadorians are going to be seeing in the future. And I don't have time to go through this.
I was actually going to ask you a question about decoupling, because I love the framework that you've put out there, and particularly how the way we think about things may have helped us in the past, may not help us going forward. So if I could ask you that question with regards to decoupling, how we should really look at that, because it's very salient right now between East and West and China and the US and so on. So I'll come back to you on that one. Joining us from here, now we're back over here, I'm in Singapore, and with me here, somewhere not too far away, is Bob Mainprize. Bob is currently Managing Director of Risk Management at Temasek Group. For those abroad who may not be aware, Temasek is an investment holding company owned by the government of Singapore with a portfolio size of over $280 billion US. Previously, Bob Mainprize was the Asia Pacific Chief Risk Officer at Barclays Bank, member of the Asia Pacific Executive Committee at Barclays, and he's a distinguished fellow of the Institute of Banking and Finance, IBF, here in Singapore. Bob, over to you.
Thanks, Sophie. Just a little bit of background. Those who don't know Temasek, those of you in Singapore, I'm sure do, but people in Europe, we're, as I said, owned by the government. We have a portfolio now that's nearly 400 billion Singapore dollars. Nearly all of it is equity, and a lot of that is illiquid equity. So we are naturally incentivized to spend a lot of time thinking about long-term risks and how they might impact on our portfolio. So just a few thoughts following on from very interesting remarks of the other people on the panel. I think a pick up on, we are very bad at identifying what risks are, actually, and we're very bad at identifying what the pertinent material risks are, even in the short term, let alone in the long term. And I think it's interesting to reflect, historians might look back at 2021 and think it's odd reviewing the press or the financial press about what we were actually concerned about at the time. If you look at what people are worried about now, we're worried about inflation, we're worried about long-term climate risks, but there's very little talk about pandemic risks, and we're in the middle of one. But very little has been done about what happens about preventing the next pandemic. If you think about the problems that we've got that have been caused by ecological changes that haven't necessarily affect climate so much, but have had an impact on the environment, and those have led to transmission of disease from other animals to humans. Very little has been done to actually correct that. And just because we've had one serious pandemic, arguably the most serious since the Spanish flu in 1917, doesn't mean that we won't be subject to another one quite quickly. We have far more people in the world than we've ever had before. We have far more domesticated animals than we've ever had before. They're in much closer proximity to human beings than they ever have been before. We're using far more antibiotics in the animal rearing system. So if you really wanted to create a perfect environment for pandemics, we've done it, and we've had a problem with it, and we're doing nothing about it as it stands. And although medical science has done a fantastic job at developing new vaccine technology, I'm rather concerned that might actually lead people to a full sense of security about taking immediate action to prevent the next pandemic. So that's my cheerful start. I think, again, I'd echo what Peter said about, and Ron, about the need to look back in thinking about long-term risk, partly because, as I say, we're not very good as to actually thinking about what is risky at the moment. But we do tend to be quite short-termist about this. I think the sort of culture of just looking at whatever you can see on your Bloomberg screen is defining what ancient history is. But obviously things happened before 1980, which is generally when most Bloomberg time series start, and they are very important. The last 40 years or so, financial market history have probably been somewhat exceptional. We've had more or less a continuous bull market in bonds. So interest rates, and I actually started work, funnily enough, at Barclays on the day that the US Treasury bill peaked at its highest ever yield. The 10-year rate was just under 16% when I started work, and since then it's more or less declined continuously within a relatively narrow range. Now that is pretty exceptional. Even more exceptional is declining real rates. Again, even a few years ago, if you had gone back and asked people what the natural real rate was likely to be, very few people would have given you a number below 1%, and almost nobody would have given you a negative number. And yet here we are with significantly negative real rates in most major economies. And we haven't seen positive real rates this century at the short end of the curve. So the monetary regime has completely changed, and I don't think anyone saw that coming. But is it exceptional? Probably, hopefully, maybe, I don't know. But you're not going to find out much about other economic regimes if you just look at the last 40 years. So I think going back in time. The other thing that's changed, obviously, is we're now entering into a regime shift in terms of geopolitics. We've had a long period of American leadership in the world, one way or another, and that is clearly changing. And one thing that history teaches us is that these periods of transition in terms of top dog to being challenged into a more multipolar regime are usually very unstable geopolitically. And you can add to that the worries that we've talked about already today about the climate impact and the impact of humanity on the planet. And that's something that we're having to deal with now and is likely to become more significant problem as we go forward. So all of that makes the risk picture very difficult to predict. I mean, we're not good at identifying the central path, let alone the shape of the distribution around that central path. And if you think about, Ron mentioned the example of the GFC in 2007. Nate Silver, in his excellent book, The Signal and the Noise, which I recommend to everyone, made the point about the Fed's economist survey in 2007. It's a survey that the Fed conducts on a regular basis, and is anonymized to avoid the issue that street economists might be worried about making a non-consensus forecast. But in the last forecast of 2007, none of the economists surveyed by the Fed actually predicted a recession in 2007. So even very shortly ahead of the largest recession that we've seen since the Second World War, it wasn't been predicted by street economists. So if you can't get the central prediction right, how hard is it going to be to actually identify what's going to happen in the wing? So what would my recommendation would be? Well, I come back to what Ron was talking about, and that's very much dependent upon stress testing. I think stress testing has a number of advantages. If you're imaginative about it, about things that can happen, one thing you don't have to do in calibrating a stress test is actually think too much about how likely that stress test is to occur. Now, obviously, you want it to be rational and not completely fanciful, but different users of the same stress test can have different opinion on the probability of it occurring. So from that point of view, it's actually quite a useful shortcut to defining your risk appetite. We can all look at it and we can say we've got this much risk. If this scenario eventuates, we're going to lose this much money. Are we happy with that in the context of the probability of this scenario happening? So it's a useful tool from that point of view. The other really useful thing about stress testing, and I guess Ron touched on this as well, is that you can use stress tests and stress test results as something of a dress rehearsal to what you're actually going to do when you get into that circumstance. And I think history tells us that most institutions react quite badly to crises and unforeseen crises, and tend to do some things that actually are quite value destroying in the crisis moment. Like all emergencies, I think we practice for cyber risks, we practice for fire drills, we should practice for financial crises too. And using a stress test to do that, I think, is probably the most valuable thing that you can do, apart from you define your risk appetite. The other issue I'd like to raise there is what I call the boiled frog problem, and that's that it's very easy to drift into a higher risk scenario without realizing it. On a day-to-day basis, things change slowly. You can find yourself with a substantial amount of risk that you never really thought about having, but it's built up over time and is slowly materializing risks. I think setting down risk parameters at which you're going to revisit your risk position that are calibrated to market observable indicators is a very useful practice. So an example might be you could pitch your risk appetite to credit spreads or to implied volatility or some other risk indicator that's easier to observe. And once it crosses a certain threshold, you can revisit your risk appetite. The questions also raised about how you set yourselves up for credit and operational risk. That's a complex topic, so just a very quick comment from me. On the credit risk side, I think most institutions are very good at identifying what I call straight line of sight default probabilities. So we lend money to X, how likely is it to get it back? We run our credit models and we come up with a probability of default, loss given default. We can run all that through the system, and that I think most institutions do pretty well. What most institutions aren't so good at is identifying the correlation risks in their portfolio, and that's loan-to-loan default correlation, and also the correlation of exposure to the default probability of their counterparties, and that's under-engineered, I think, for most companies, and so that's something that I would recommend we all think a lot about. Operational risk, my advice on that one would be to keep the operational risk department as small as it possibly can be. It shouldn't be something that's outsourced. Operational risk should be managed by managers in the businesses. Operational risk can be a technical expert who can come in and identify problems where the risk management structure isn't sufficient. But I think having large operational risk departments, which a lot of institutions do now, is actually counterproductive, because it allows actual frontline managers, who really are the people who should be controlling that risk within the institution, to, in a way, pass the buck. Conduct risk was another topic to be discussed. My favourite quote in this space is one about culture, the culture in the company. And culture is what happens when no one's looking, and I think that's quite a nice quote. I suppose conduct risk is what you find out about when people didn't think anyone was looking, but actually they were. So be careful on that one. I think one thing financial institutions in particular spend a lot of time worrying about in conduct risk space is the impact of remuneration on behaviour of their employees, and that's right. The incentivation, financial incentivation, is important, and so there's been legislation about bonus practices, and there's been a lot of commentary on that. I think one factor that's been less talked about and is possibly under-regarded is the employment practices of financial firms generally, and all firms actually. Increasingly, people realise that their jobs are less secure, and so a lot of the bad behaviour is often to protect employment or perceptions of threats to their employment. If you think about a lot of the conduct risk problems and unauthorised trading incidents, they've largely been around people trying to cover up mistakes. So a culture where people don't think they're going to lose their jobs if they have a bad quarter sales-wise or trading-wise, or they make a mistake operationally, could be much more beneficial for the firm. Regulators also have a very big part to play in contact risk and systemic risk. I mean, we look at the amount of money that's been spent in the last few years, going back before the GFC, in fact, on increasing financial regulation, the complexity of financial regulation through Bar 1, 2, 3, 4, 5. It runs into potentially billions of dollars that have been spent in the industry on improving, in inverted commas, regulation. And a lot of that, and it's not just me saying that, but a lot of regulators say it as well, has been wasted. It hasn't actually done very much other than just increase the complexity and the lack of understanding in the system as to what the real risks are. And I think that pairs attention from the regulators. I mean, a great recent example is the Archegos saga, where despite the considerable amounts of money and considerable amount of effort, the bureaucracy that's gone into trade reporting, the regulator still managed to miss the build-up of staggeringly large positions by one family office. And what was interesting was a lot of the immediate reaction on that one was that we needed more regulation, that we needed to bring family offices into the regulated sphere as well. Well, actually, I think personally, the better thing to do is actually go back and revisit, well, are we looking at the right thing in this trade reporting environment so that we can identify the big risks? More regulation, would it really work? Perhaps what we need is more effective regulation in that space. And we also need the regulators to protect financial industry from bad actors or irrational actors. And I think that's something only a regulator can do in the final analysis. It's very difficult if you're a financial institution to compete against someone who just has bad risk management practices, because in the short term, it will look like they're doing the right thing. It takes time for loans to go bad. I guess it takes an insurance industry, I'm not expert on that, but it takes time for badly underwritten risks to come home to roost. So in the short term, your competitor who has a crazy attitude to risk is going to do very well. And the financial markets aren't always very good at identifying that. And that allows a bad actor to look very successful and to accumulate the firepower to go on an acquisition spree. So we saw it before the GFC that a lot of very good financial institutions were bought by very bad financial institutions, which just added to the systemic risk. Finally, in the interest of time, ESG. So I'd echo the comments that have been made again by the others on the panel about a little bit of caution on the ESG front, about that we actually do the right thing and we think carefully about where we launch. There's a danger to just act on things because we can measure them. A lot of the ESG risks are things that will take a long time to manifest themselves in terms of financial impact. So there's I guess an understandable urge to do things about things that we can measure and things that we can see. But a lot of the metrics are actually quite imprecise. The valuation of risk to ESG is actually pretty tricky, because a large component in any modeling has to be the adaptation profile of how different financial actors will react to changing carbon prices or changing climatic conditions, and factoring that into your models is far from straightforward. Indeed, the climate models themselves are extremely complex and probably quite inaccurate. And I don't mean that as any disrespect to climate scientists, but they've got a very difficult job to do because they're dealing with so many uncertainties in such a complex system. So again, in the same way that the economy is a very different thing to model, and we're not very good at seeing recessions before they happen, and we're not very good at seeing the wing risks in the economy, probably the same things apply in the climate. So one thing that troubles me is that we're possibly underestimating the probability of a significant overrun in the climate projections that we're seeing. Final comment on that would be there have been some fantastic moves by the private sector to try and tackle environmental concerns and ESG risks more widely, and we're seeing that on private individuals investing into ESG funds. We're seeing it by companies themselves trying to improve their ESG performance, and we're seeing it by asset owners and fund managers who are directing their funds accordingly. But at the end of the day, the government still have a huge part to play. A huge amount of emissions come out of the public sector. In fact, the minority of emissions come out of private-owned corporations. So, referring back to the work of the late Professor Weitzman, who I'm a big fan of, is an advocate of global taxation on carbon. And to my mind, if you're going to really address these externalities that aren't priced, the way to do that is through government action. And it can't be done by the private sector alone. Private sector has an important part to play, but it can't do it on its own. So, Luffy, that was my little canter through your menu of questions.
Thank you so much, Bob. That was terrific. Thank you, everyone. Let's do a relatively quick round of answers to the questions that I have for each one of you. And Bob, we'll come to you last. My question to you will be taking from something you just mentioned about complexity, regulatory complexity. And then early on, you mentioned the 10-year Treasury yield and where we are right now. Looking at extraordinary monetary policy, is there a non-violent exit possible from QE ever? And the layering of complexity in regulations without going back to first principles. My question is, are regulators and monetary authorities now net contributors to risk or net mitigants and reducers of risks? I'll come back to you with that one. Christine, so the question I had for you was about stranded assets, particularly financial assets that are overlaid on stranded underlying coal and other assets. What's your view on that? Are we underestimating the scale of that?
Would you like me to answer it now?
Yes, please.
Sure. Well, there's been a lot of discussion at IASB and also different working groups already about that topic. So under the existing financial accounting system, I think that we are in a good shape.
Sorry, you're breaking up, Christine. Can
you hear me now? Is that better?
It's a little better, yeah.
Right. Maybe I'll turn off the video if that's easier. So I was saying earlier that there's been a lot of working groups, discussion group at IASB, IFRS, financial accounting groups has been talking about this issue for quite some time. So under the existing accounting framework, I think we're in good shape. And the impairment of assets have already been considering. So I don't think we are in a position where the stranded assets topic has not been adequately addressed. It continues to evolve. But I want to respond to what Bob said earlier about risk metrics. I absolutely agree that there is this obsession in the industry which believe that the more metrics we come up with, we are better in managing risk. I want to say that this is not true. It's a false sense of security that if we have more metrics, we are better managing the risk. So this is something I think we need to really watch out as an investment industry on that topic. And it's similar to linking back to whether it's stranded assets or not. It's the fundamental understanding of the nature of evolving risk that matters more than setting up 100 different metrics and try to measure it. And I think at the end of the day, we might end up finding that we spend so much resources in setting up these metrics and it doesn't deliver the return on investment that we thought we would get. Thank you.
Thank you, Christine. Peter, my question to you is like over-dramatizing it. Are you saying we shouldn't do anything because the future is so uncertain?
Well, I'm not quite at the age of retirement, so I'm not falling into that trap. And I obviously we should risk management is kind of recognizing the uncertainty, the volatility, and working with tolerances. And once you see the potential negative volatility and put that on the time axis, it becomes a discussion around what tolerance do you have at what point in time, and you can weigh that against the cost of the mitigation measure and the effectiveness of the mitigation measure. And the further out you go, the less can you point mitigation measures. So the higher your tolerance becomes, because you will also have more time to react. And I think that whole discussion around stranded assets is a perfect illustration of that. If you think about the reaction to climate change, by the way, if it wasn't climate change, it would have been the exhaustion of the oil wells at one point in time, because it's a finite resource, so it will need to be replaced. So we will end up in a carbon-free society. That's nothing but an industrial revolution. In every industrial revolution, you have winners and losers, and the losers become stranded assets. It's no different. the thing I don't quite understand is why we discuss this as a special case. This is a general case of a technology shift. We don't know the outcome, which is the nature of the technology shift, but that's what's bound to happen. I mean, if you were a typewriter producer in the 60s, you had some strategic challenges ahead of you. And whether you became a stranded asset or not was determined by your ability to adapt. And for me, that's the key, is the constant adaptation to a changing environment is a very effective risk mitigation strategy. And one of the things you should not do is determine kind of your fate and your mitigation measure today for a very long period of time, because that may give you a false sense of certainty, for one, and second, will likely prove ineffective because you banked on one scenario, but the future is an endless number of scenarios.
Thank you, Peter. It reminds me of that classic quote about, you know, how the Stone Age didn't end because the world ran out of stones. So if I could come to you now, Ron, your approach, and I particularly liked what you said about war games by diverse people coming together. And I remember we did one in London not too long ago with the Ministry of Defense on cyber risk, and imagined that it's coursing through the financial system and how that would pan out. So, Ron, your view on decoupling. How should we look at decoupling as a long-term risk that we need to tackle?
Well, what I would say is that people have already started to think about Cold War scenarios. And I think that it's interesting to exercise our imagination a little bit about that and rethink a little bit what went on in the Cold War. For me, I sketched in my last slide the game form that we should be looking at, and that the outcomes were win-win, win-lose, lose-win, and lose-lose. Okay, and which of those might really be coming down the line? And I think to flesh that out, we should be focusing on something that's talked about quite a bit: disruption of the supply chains. And so lose-lose is the loss of economies of scale that are available to us. And I think people are, some people are infatuated with the idea of a Sputnik event that's going to unleash a new technology and everything's going to be fantastic. But they should also think through the others that involve losing, okay, and maybe really lose-lose, okay. Now, in the context of this specific rivalry, the disruption of supply chains means an existential threat to the growth strategy of China, and the alternative to expanded, world trade, free trading system, and so forth. The Chinese always have already sort of shown the direction of their thinking with the Belt and Road Initiative. And now it's not going to be called Belt and Road, but it's going to be the same. It's going to be the same thing, but done in a more thoughtful way. And they're going to look for engagement in the world where the Chinese comparative advantage, an absolute advantage in infrastructure and these types of activities can be brought to bear. So that's going to be pushed. The more the US pursues a strategic competition that it's currently talking about and so forth, the more that's going to be the response. At least we should think about that. And where could that lead?
Thank you, Ron.
Yeah, that's what I would say.
Thanks very much. So, Bob, now the easy question for you. Are regulators and monetary authorities?
Sorry, Luffy, either I've frozen or you've frozen.
How about now? Can you hear me?
Oh, yeah, you're good. You're back, or I'm back. We're both back.
Okay. Did you hear the question?
No, could you repeat it?
Yes. So the question is: are regulators and the monetary authorities net suppliers of risk, or are they really mitigators of risk?
I think that the world would be a riskier place without them, quite definitely. I think, you know, like that, and I think it's easy to criticize the regulators, and I just did, but it's not an easy task that they've got. Yeah, so I think net they do help. That said, I think that, you know, they're the things that could be done better, and I'm sure, and regulators themselves say it all the time. So I'm not unique in that. I mean, I think in some jurisdictions the regulatory system is probably overcomplicated. You know, people talk about the US having, you know, numerous regulators, and that's probably counterproductive at the end of the day. And maybe we saw a bit of that in IHS. Obviously, the regulatory environment in some countries is highly politicized, and again, the US might be an example of that, and that doesn't help. But I think the regulators, there's very capable people generally, and they're trying to do the right thing, in a not always easy environment. So I think, yeah, there's always things that could be done better, but I think net they're a positive.
Thank you very much. And with that, we have come to the end of our time. So thank you so much to the panelists, and thank you so much to all of you who have joined us today. And with that, we bring this panel to a close. Thank you.
Thank you.